Good evening to all of you. Welcome you to today's webinar. Today we are going to look at some investments and particularly some of the schemes, mutual fund schemes which I have elaborated earlier. But you are going to see some differences between different types of funds. Already we have talked about the mutual fund investment as a very safe investment compared to even individual stocks, because here when you do a mutual fund investment, you let us say equity mutual fund, whichever mutual fund that you take, it could be a large cap fund, it could be index fund or index ETF, it could be mid cap, it could be small cap, or it could be flexi cap. So there are different types of funds, right? So whichever one you do it, you have a basket of stocks, so you're not betting on any individual stock. To that extent, the mutual fund investment is safe. Second thing is that instead of trying to predict day-to-day levels, because it's very difficult to keep track of each individual stock, because you can invest in one or two stocks or a few stocks, 5, 6, 7 stocks. You can't invest in 20 to 50 stocks and then keep tracking those stocks. So instead of that, when you do a mutual fund investment, also the levels at which you do, probably you don't need to be worried about which level it will take support and all. So you can do a systematic investment plan, every day, every week, every month, or some frequent intervals, or some at frequently set prices. You can buy a mutual fund. So that probably will enable you to average out at various levels and give you a return over a period of 3 years and 5 years. So that is considered to be a no-brainer and a very safe solution for investment. So this is the first step that any investor should take, because if you do this, mostly over a period of 3 to 5 years, you will get anything between 12 to 15%. Okay, notwithstanding the present fall which is taking place, for a period of 1 to 2 years or even a couple of years, you are safe of getting something like 12 to 15% return in most of the mutual funds. In that, there are different sectors of mutual funds which will satisfy the objective of every of a particular individual or a company, because each investor has got very different objectives of investment. Probably some will be very aggressive, some may be conservative. The same person could be conservative at some stage and could be aggressive depending on his age profile, also depending on his stream of income at a point of time. So those things, it keeps varying. So we can't map somebody saying that they are very conservative always. It's not that. It's a question is that age factor matters, because where probably you will be looking for very safe inflows sometimes. That is one. And second thing is that also you will be looking at various other type of obligations in life that you may have to meet. For example, the studies of your children, marriage, and all those things. So accordingly, you will plan the tenor also. So based on all these things, and also of course the taxation part is also involved. So we need to keep all these things in mind before we come to decision what type of funds that is going to be helpful for us, because there are funds which are purely on debt, then purely on equity, then a mix of this called hybrid, then you have got a sectoral funds. So sectoral funds. So these are different types of funds are available, and each fund normally gives different returns which could be different at different points of time depending on the environment that is there. Right now, if you see, most of the debt funds may not be giving good return because the yield is going up. That is, if you see, the interest rates are going up, which means normally the prices of those bonds in which they have invested will fall. So unless it is held considerably up right up to the maturity period, you will see the NAV of debt funds either stagnant or even falling to some extent depending on the type of investment they have made. So in debt also, if you go, there are different types of funds which are purely dedicated only to gilt, Government of India security. Then there will be funds which are basically into corporate debt. There could be a mix of this. There could be short-term thing. So all these things will tell you that which scheme is going to be helpful for you at any point of time. But you need to be very choosy. Also, you have to deliberate on various types of investment that is available, and you must also find out which is the easiest way to invest also. Because right now, just to give an example, before we go into the equity type of investments, which we this one. See, today the FDs for normal people for offers anything between no 5.5 to 6.5 for normal for less than 60 years. Various banks give anything between 5.5 to 6.5% for 1 year or so. Then for senior citizens, you normally have between 6 to 7.5% in various banks, depending on which bank it is. So, but all these things are subjected to normal very high taxation. If you are in the highest tax bracket, you end up paying something like 30%. You end up paying 30%. So you will have to look at some investment which gives some sort of a return here, say the same 7.5%, but you pay say 15% or so, because most of the short-term capital gains, it is taxed at 15%, and the long-term capital gains normally comes around 10% for more than 1 lakh, right? So the short-term capital gains is taxed at around 15%. So we have to look at what type of schemes that we should invest, whether it's in equity or in debt, or what type of schemes that we should put in ourselves to get a lower taxation return and also some higher return. Now, if you see the gilt itself, let us say 2 years. 2 years YTM right now in Government of India is 7.15%. 7.15%. Now, this 2 year Government of India securities offering at 7.15%, most of the FDs don't offer. So most of the fixed deposits don't offer 7.15% still, right? So suppose if you buy a Government of India security for 2 years and hold it, you get 7.15%, right? So we have to look at whether this gilt is okay or this FD is okay, both from taxation point of view and as well as return. Suppose if you are, because this is a very high safe thing, right? So most of the FDs are giving something like 5.5 to 6.5%, when the gilt is offering something like a 7.15%. 7.15%. So this makes it very clearly that the return, we have to make a judgment. So we have to look at what are the, first of all, we must know if you are a first time investor, or probably if you are in the market also, you should now look at, say, I am in FD sector, so I want to invest in safe thing. I have a period of 2 years now, but I don't want to go to equity. Now this much of amount is available as far as safe investment is concerned, with a clear amount of cash flow to come. Then which one is more effective, both from return as well as from post-tax return? Now look at the FDs, various banks which are offering. Then look at the Government of India security also. Okay, so depending on which one is offering, you can go for it. So in this case, even a 2 year fund is offering 7.15%. So why will you not choose a 2 year fund and put at 7.15%? So when you're offering something like a 7.15% for 2 years, then the equity funds should give something, should offer something like a 12 to 14% return. Then only you will find it attractive. So now, if this is going to head towards 8% or so, let us say in the next couple of months, there is a chance that probably this could go right very closer to the 8% or so. If this goes closer to the 8%, then the equity markets will definitely not become that attractive for the time being. Will not become attractive for the time being, right? So as the interest rate peaks, closer comes to 8% for 2 years, I think the equity markets will start looking to be a little unattractive still, but at the same time it can bottom out at that point of time to go up. It can bottom out to go right up at that point of time. So now is the case where the equity markets are also not performing well, but the debt market was also not performing well because they are invested in the bond. Only thing is, if you are patient and wait till the maturity, you will definitely get a return of 7.15%. That is what the yield to maturity tells you. So now those who are new to the Government of India securities, I think we should look at a separate webinar where we should know how to invest. That is, whether we should take the mutual fund route or we should take the exchange platform route itself to invest in this type of funds. Now let us say now we will look at the substitute for this. Now substitute funds, or let us say balance fund. Balance fund is one. So today we are going to look at balance fund. We are also going to look at arbitrage fund. Then we are also looking at Flexi Cap Fund. Okay, And what is it? What are the funds that where we should not immediately invest? That also we will look at it. Now let's look at first arbitrage fund. First of all, we'll take this arbitrage fund. Now what is arbitrage? Now arbitrage is normally mutual funds. They play between the cash and futures market. So you are familiar with both the cash and futures market. Normally the futures market, because of the interest rate in India being higher at 7% or so, so the cash and futures should give that difference. No? Something like a 6 to 7% difference on an annualized basis should be there between the cash and the futures market, okay, generally speaking. But it doesn't give that much of thing. Then plus the expenses are also there. So the arbitrage fund generally these days gives something like 5 to 5.5% return per annum. 5 to 5.5% per annum, right? So what they do is they buy in the cash market and they sell in futures. So this is no risk game because you buy in the cash market and the underlying is in the cash market, and against that you sell the futures. Okay, so it is closed at the same time, and when you get that, you get a return which is 5 to 5.5%. So why you would invest in a 5.5% thing? Only issue is that if you are doing an FD with a nationalized bank or with some of the top private sector bank for 1 year, you still get, at this point of time, you get only something of a 5.5%. For 1 year, you can just check closer to 5.5% is what some of the top banks offer. But there, the taxation comes around 30%. FD taxation comes at 30% if you're high tax payer. But whereas this arbitrage funds, the short-term capital gains tax, okay, will come only at 15%. So if you're holding it for more than 1 year, then you get only 10% for more than 1 lakh. So the attractiveness of arbitrage fund comes, compared to FD, comes only in the form of a taxation benefit. So the reason that you're going to get into arbitrage fund is basically only for a taxation purposes. You save anything between 15% to 20% on the tax. So the post-tax return of an arbitrage fund is supposed to be much better than a post-tax return from an FD. So those who are looking at a FD with top banks, then in that case the substitute for them could be arbitrage fund, because the post-tax return could be better. That's all. So the objective of investment in arbitrage fund should be considered more from the taxation point of view rather than from any other point of view. And it is a safe fund because you buy in the cash, you sell in the futures, so there's not much of a downside risk. Couple of months something can be there here and there depending on the liquidity of the market at any point of time. But generally speaking, the arbitrage fund will give you something like a 5.5%. Anything between 5 to 5.5% is a return, and the benefit comes from the taxation point of view. So if you are doing an FD, consider arbitrage fund as an alternative. Now we will move to the second type of funds, that is the balance fund. See, balance fund, it is a very good fund for basically conservative investors, because what the balance fund managers they do is, see, when the market falls, okay, so it has a component of equity and debt. It has a component of both equity and debt. Equity and debt. So what generally they do is that this proportion of equity to debt can go as much as to 100% equity at sometimes, or 100% debt at some time. 100% debt, or it can be in between. So they have the flexibility to be 100% equity, they have the flexibility to be 100% debt, or they have also the flexibility to be in between. So what they do is that normally if the market falls, if the valuation becomes attractive, as the market falls, they increase the exposure to equity. As the market falls, as the valuation becomes cheaper, they increase the weightage in equity, which means there's a higher chance of making a good profit, okay, in future. Similarly, when the market goes up, when the valuation it's a very important high, then in that case, no, they reduce the equity exposure and go into debt. So that means automatically what probably you should have done, because that is what we are supposed to do. That is, whenever the market falls, we should increase our risk in equity. Whenever it rises to certain high levels, we should keep cutting it. So we do not know what is the high and low, right, from the valuation point of concern. But the fund manager, because of the research ability, will be able to identify what is a valuation, stretched valuation, or probably underpriced valuation. We have seen in many webinars in recently that the one of the valuation parameters is the price to earnings ratio. One of the valuation, not the only one, but price to earnings. Then let us say the price to earnings, if it goes to 5-year average, which could be 25 in case of Nifty, probably they may feel that it is becoming expensive, and they will start cutting this down. Okay, and this is only a benchmark, because there could be other factors also. Suppose if this comes to 19 or 18, okay, which is the 5-year low right now. The 10-year average is something like a 17 or so. Okay, so if this comes down to something of this level, probably they will increase the risk exposure in equity. So what we normally supposed to do, the fund manager does, and so the balance fund typically gives a very smooth return, okay, with very less risk. That is, if you look at the return in other schemes, you should also consider risk. So what type of risk that return came. So that is how you have to look at the risk adjusted return. So the balance funds gives a good risk adjusted return compared to other funds. Suppose at some stage of the rally, if you have invested only in large cap or mid cap or flexi cap, probably the return may be, say, let us say 18-20%. The balance funds might have given only 13 or 14%. But even in the case of a fall, okay, if the equity markets is giving a nil return or a negative return, the balance funds will still be giving a decent return. The balance fund will still be giving a return. So the balance fund is a combination of most of the equity investments. Normally in balance funds comes from large cap stocks, mostly from large cap stocks. The objective of the fund manager is to invest in equity of large cap exposures mostly. And then there will be debt, which could be a form of both government debt as well as corporate debt. So considered to be a little safer investment, which can over a period of time give something like, even there, 3 years, 5 years, 10 years, normally they will give 12-13% return. Okay. Even in the case of a fall, normally 8 to 9% is possible. So we will look at some of the fun performance that may have seen in the last couple of months or so. So look at Indian balanced funds performance. Okay, so now let's look at the balanced funds. So mutual funds, we'll look at the fine fund. Okay, we'll put it there. Let's say ICICI balance fund. So okay, we'll get this just for ICICI Prudential Balance Fund. Just one scheme illustration. So if you look at the Nifty, so in 1 year, let us say Nifty has given a return of 1.43% only. That is, compared to 1 year back, Nifty has returned 1.43%, but whereas this scheme has returned 6.33%. So even in the case of a fall, this has given a return which is better than FDs, right? So 6.33% we have got. So let us look at the performance over a period of time. Now annualized return in the last 2 years is 16.08. 3 years is 13%. 5 years is close to 10%, right? So 5 years is because of the fall that has taken place. 10 years is 12.28%. So anywhere we are getting anything between 10 to 16%. So depending on which period we are. So if you look at a 5 year period, they are third out of so they are ranked 2, 3, 5 or something like that of that particular thing over a period of time. So let us say this is one of the funds that where you are doing it. Here there's no need for any big SIP type of return. We are sure that even in 1 year when the market has fallen, this has given a return of 6.33%. 2 years when the market did well, the last 2-3 years, it has given something like 13 to 16%, and last 5 years it has given something like a 10% return. So still a good return scheme, balance fund. And if you see for the total risk that we have taken, I think this fund has done extremely well. I'm not talking about ICICI alone. Probably we can even look at Tata, another fund which is doing well is let us say Tata Balance Fund. So this scheme in the last 1 year has given 5.26%. Let us say last 2 years, same thing like ICICI 16.67%. 3 years it has given 14.94%. So very similar to what ICICI fund has given. So this is something also in the same ranking, second, third, fourth, or something rank of that ranking. So this also is given. If you see, there is no 5-year track record. Yes, because it was since inception 2019. So to that extent, we are at 13-15 levels. So what we could probably understand is that it is something a balance fund gives something like a 10% definitely. And also in the last 1 year only, when Nifty was not doing well at all, it has given 6.33%. So a very good substitute for investment in Nifty, total Nifty. We can go for this type of fund for those who are conservative. Okay, there you can tweak it in the sense that probably you can also look at systematic withdrawal plan after 1 year. After 1 year also, so probably you will still have a good return even with a systematic withdrawal plan performance. So this is one scheme that probably you can we can look at it. So this is balanced fund, is a mix of both equity and debt. An exposure can go up to 100% in equity or 100% in debt. It is raised to 100 higher equity exposure is given as the market falls and valuations become cheaper, and when it goes up, then the valuations become expensive. More of equity is turned into debt, and most of them give anything between 10 to 16% over a period of time. So we clearly, again, as far as from the taxation point of view also, from the return point of view also, and a very systematic income, suppose if you want. So those were even senior citizens, or probably just about to retire, can consider this fund even for a systematic withdrawal plan, something to act better than FD, something to act something similar to FD but better than FD if you do a systematic withdrawal plan after 1 year in a balanced fund. So we have seen what is a hybrid fund, what is a arbitrage fund, which is to be invested only clearly from a taxation point of view compared to FD. In a balanced fund can be a very good substitute for pure equity fund also. Do a systematic withdrawal after 1 year, still can be a very high return, and even in the falling equity markets time, this can give a very decent return, which has been illustrated in the last 1 year performance also. So some of this funds performance we showed, not that we are recommending these funds, but we are saying that just to give an illustration of this particular fund. Okay, now the other one, which is the Flexi Fund. Now, so those who are willing to, now we have talked about low risk category, then we are looking at some high risk category. High risk category is Flexi Cap. This could be a high risk cap because the investment could be large, mid cap and small cap, and there is no clear limitation. See, in the case of multi cap, now there is a difference between multi cap and Flexi Cap, because here there is a restriction on the percentage of investment in medium cap, percentage of investment in small cap. But whereas in the case of Flexi Cap, there is no clear demarcation between the type amount of investment that you should do in a mid cap or a small cap. Okay, so the Flexi Cap Fund is a high risk category. So in that particular case, what type of strategy that you should adopt in order to get a good return? Now, we do not know when the market falls. So let us assume that we cannot time the market, nor we have the innate ability to understand the market to that extent deeply and to go for an investment. So the best thing that we do is that we want a higher return, and higher return over a period of time. Okay, 3 years, 5 years, and we cannot invest in one shot, because let us say we are investing when the Nifty is 17,200. So we are not sure whether it is going to be 18,500 after 1 year, or it is going to come down before it goes up. So we do not know about that. Over a period of time, definitely equity markets are going to do well. There's no doubt about it. But within that, whether they're going to be fall and then rise. Now, in a situation like this where the interest rates are going up, definitely the equity markets face a very great resistance for its upward movement, right? So because of that, there will be fall. Only thing, Indian market is outperforming other markets by not falling to the extent of what the other markets are happening. Okay, so we do not know whether this will get tacked up over a period of time. But right now, there is a fear that markets can probably again have some sort of a fall. Let us say if that be the case, then in that case, if we you one strategy is to completely wait out and then buy only when you are very sure about the market's turn. Okay, so that means fundamentally we should be in a position to assess when the markets can make a turnaround. So we have to look at the macro data which comes globally. It could be the interest rate, where Fed signals that yes, interest rate has come to a peak. Now interest rate is going to end. So then in that case you go for a massive investment. To whatever extent that you can invest, you invest in equity, and in that case you invest more in Flexi Cap. So suppose if you get a clear feeling that interest rates have peaked and things are going to move up and do well for the equity markets, then the Flexi Cap can give a much higher return than multi cap or even large cap, mainly because the Flexi Cap has got high beta stocks. That is, its ability to perform will be much greater than Nifty in an upward movement. So in those cases, we can see the Flexi Cap doing well. But let us say we are not very sure about when it will have a turnaround, because we do not know when the turnaround take place, and on that day whether we will be able to invest. So those issues can be there. So if that be the case, then from the Flexi Cap straight away we will now look at the Flexi Cap itself. We will look at SIP, because let us say in the next 1 year or so, the markets are likely to have a lot of resistance, because another 5-6 months I think the interest rates will continue to go up. That's how the situation looks like. So let us say 5-6 months or up to 1 year also, the markets may not be either in a range, or it can fall before moves up. So what we do is that we go for a investment in Flexi Cap through a systematic investment plan, and you can see the performance. See, even during the type of the pandemic time, who could have predicted that pandemic? So there was a sudden crash, okay, of 35% to 40% in large cap stocks as well as in the broad index itself. So during that point of time, if somebody had done the SIP, that would have been better rather than one-time big investment at a peak. Now, if we talk about the Nifty right now, it is 17,200. The high that we saw was 18,600. So it is not even 2,000 points lower from that right now. So we are only some 7-8% from the peak. So normally we should see if at all the market is to capitulate, okay, then in that case it should go down right up to 20 to 25% down. The broad index should be at least to 20 to 25% down, which means in Indian market it should come closer to 14,200 to 14,400, which means market is capitulating at that. If that be the case, on that day, on that time of capitulation, around that capitulation, then in that case a big one-time investment of Flexi can be done. But right now the movement is very, very at least Indian markets, it is either moving up, coming down, again moving up. So both the bulls and bears are confused that where we are heading towards. Some days the bulls seem to be taking charge, and again the bears come back. Okay, then again on some fall the bulls take it up. So right now we have a situation like this. So in that particular case, let us say we do a systematic investment plan over a period of say 1 year or 2 years. Okay, if the market stopped falling and started to rise after a fall, then in that case you just do a systematic investment plan for 1 year and leave it, because there's no point in trying to average at higher levels. Okay, so let us say we do for 5-6 months. Within the 6 months there is a capitulation comes. Then in that case what you do is that you make one big time investment. No, so SIP, you can call it as SIP, or you can say every month you yourself will invest, rather than putting it as an, rather than talking about it as an SIP. Let us say you yourself are investing every month some amount, say 5,000, 10,000, like that you are investing. So let us say you keep on investing at every short low level. Then on one particular day, let us say the market capitulates completely. Okay, then in that case you make some big investment. Okay, that particular type of working, that is where you keep working on every fall. Okay, like a balance fund, that is increasing your exposure to equity as the market falls, as the valuation becomes cheaper. Then on one big fall, you increase your investment a little more significant. Let us say you're doing 5,000, 5,000, 5,000 at falls. Suddenly market crashes, then you make an investment. Let us say you are done for 6 months, for 6 into 5 is 30,000 rupees. Then you invest some 20,000, 30,000 rupees, equal to whatever that you have invested at that point of time. You do the SIP, definitely at some stage that you will see the market kicking up and giving a very good return. So the SIP returns in the systematic investment plan can sometimes be more than one-time investment. That we will just illustrate it. Now, but whereas in the case of balance fund, there is no point in doing SIP. You can do one-time investment at any point of time. The return will not be that different. So we'll just have one look at some fund, Flexi Fund. So just PGIM Flexi Fund, let's say, just for understanding purposes only. Okay, it's not that we are recommending anything. PGIM India Flexi Cap Fund direct plan. Okay, so this scheme, if you see the last 1 year or so, okay, compared to Nifty 500, because they are taken in the case of Flexi Fund, the benchmark is taken as Nifty 500 DRI. Okay, so if you see this has given minus 4.22%. Okay, Nifty itself has fallen by 1.43%, but this has fallen by 4.22% because it contains some riskier stocks compared to the Nifty. So Nifty 500 itself only 0.75. So let us look at this category. If you see the last 1 year, it's a minus thing. Last 2 years annualized returns 29.25. Last 3 years is 26.89. 5 years is 16.4%. So the 5 years return is 16.47%, whereas in the balance fund we saw in ICICI something closer to 10%, right? So that means and also here the performance, whenever the market has done well, Flexi Cap has done much better than balance fund. Flexi Cap has done much better than balance fund. So we will look. This is one-time investment. So we will look at the SIP returns. So SIP returns in the last 1 year, if you see, the absolute returns is only minus 0.44%. So one-time investment is minus 4.23%. In the last 1 year, if you have invested, okay, it is only minus 0.44%. Last 2 years, it has given annualized return is given 12.08%, but whereas 2 years this is given 26.16. But if you look at 3 years, this is given 23.62, and this has given not much of a difference, 26.89. 5 years 16.47%, whereas this has given 20.87%. So in the case of a Flexi Cap Fund, I think the returns are much more smoother, because even in the case of 1 year, it is only minus 0.8% annualized return. Minus 0.8% annualized return is there. So which means this game definitely is a very much more better. That is, SIP scheme is much more better as far as the SIP route is concerned, as far as the Flexi Fund is concerned, which can offer a very good return, anything between 12% to 20%. So Flexi Cap Fund also should be there. So those who are looking at a big growth over a period of time should be looking towards Flexi Cap Fund, because this will have both large, mid cap and small cap fund also. So if you take any small cap fund, probably the return will be much higher. The mid cap or small cap funds exclusively, if you remove the Flexi Cap, you will even get a much higher return. Let us say just to illustrate, there also it is better to go with SIP type of scheme. So Nippon Small Cap Fund is one. Nippon Small Cap. Okay, Nippon Small Cap. In fact, the return the last 1 year compared to Nifty is much higher. It has given 12.86% in the last 1 year. It has given 12.86. That's a very good return for a small cap fund. And if you look at it there also, annualized return in the last 1 year is 12.86. 2 years is 49.22. 3 years is 37%. 5 years is 19.25%. 10 year is 25.5%. So this has created a tremendous amount of wealth for those who have done this. And if you look at, let us look at the returns, SIP returns. 2 year SIP return, 1 year SIP return is given 10.54%. Absolute returns, annualized returns 20.06. 2 years as annualized is 33. 3 years is 41. 5 years is 28.31. So excellent small cap fund. That's an excellent small cap. So this can give a return which is even better than the Flexi Fund. That means what it shows very clearly is now the Flexi Cap Fund contains large cap and small cap, right? Large cap plus small cap. Now the that means the large cap has not done that well, but the small and mid cap has done extremely well, and it has lifted the return of a small cap fund much higher than the Flexi Cap. Means that the large cap funds have not done that well. See, one thing is because the large cap, normally the investment comes from FIS. So when the interest rates generally go up, when the interest rates go up, normally the large cap funds, the FIS are sellers in large cap funds. Small cap and medium cap are generally lapped by domestic institutions. So there is a lot of buying by domestic institutions and there is selling by FIS. So that is the reason why the large cap funds is not doing that well. Okay, that means the return on the Flexi funds is not that much. Okay, so the small cap funds, I think yes, we should look towards the small cap funds also. So that is one. But large cap funds, one thing is that it just averages for a period of time. So the investment should be spread in Flexi Cap, small cap, balanced fund. So let us say you got 10 lakhs of money to invest. So let us say for in equity, then 10 lakhs, you can put say 3 lakhs in balanced fund for a conservative thing. So 3 lakhs you can put in Flexi Cap. Okay, 3 lakhs or 2.5 lakhs, probably 2.5 lakhs you can put in small cap SIP. Both Flexi Cap and this one you can put in small cap SIP. Then probably 1.5 lakhs you can put it in multi cap funds. So you will have a good thing instead of trying even for a sectoral thing. Sectoral thing is, of course, you have to look at IT funds, which is much better. I think now banking is doing well. So you need to really spot out which one is going to be attractive at what point of time and do it. And that will depend on the valuation. So you have to judge the valuation and do that. Okay. So this is how normally, you look at returns based on the objective that you have. So we have discussed about arbitrage, balanced funds and flexi funds. Now there are other funds where probably you can wait to do that. Not that it should not be done, like commodity related funds, like now gold. Now gold you can either go into ETF, okay, or you can buy as bars, or you can buy a sovereign gold scheme, sovereign gold bond scheme. And we have already highlighted that sovereign gold bond scheme is much better than pure gold ETF, because you get 2.5% or 2.5 or even more as far as the return, that is interest rate is concerned. The gold price falls as far as the gold international gold price is concerned, but that is compensated by the rupee to some extent. So you don't see much of a dip in the price factor as far as the gold is concerned. Plus you get a 2.5% or 3% whatever returns that they are offering that. So this can some other over a period of time can give us something like 8 to 10%. And this is also attractive from the taxation point of view. So this is sovereign gold bond scheme is another scheme that probably you can consider. But considering the present fall in the gold prices internationally because of the rising interest rate, this scheme can be done next year when the interest rates bottom out. So sovereign gold bond scheme can be done next year. Now, so with this, what we'll just in the next 5 minutes we'll look at the market situation right now, overall what's happening in the trend. So right now we see the of course the US markets going down by around 2% because we got a very good data from US, and that is getting reflected in the price right now. So this if you see whatever happened from this particular high to this level, the Fibonacci retracement it has come closer to the 61.8% retracement, right? It has come closer to the 61.8% retracement, ripe for a fall also, ripe for a fall also. So we could look at so this is the place normally. Now there was a high, then there was a fall, and then it rallied. So any break below this high, 17,187, any fall, sustained fall below 17,185, 187 means that probably we would have come to the I would say the correction, that is, which started from 16,747 to 17,428, approximately 700 points. So 700 points correction would have come to an end, because here also if you see there was a 700 point correction, 17,992 and 17,166. So approximately 740, 750 points. And here also it has happened the same way, around 747. This is 428. So approximately 700 points of correction has taken place. So it should be going by the correction parameters. I think they should have come to an end. So we're expecting that with the fall that is happening in SPX right now, be careful on any dip below 17,160, 170 levels. So then in that case the recent rally would have ended, and probably we may get into a fall again, probably going back to the same 16,740 or even slightly lower to the 16,430, 440 before the next meaningful bounce takes place. So to some extent we could expect some sort of a fall to come here, but overall Indian markets are much better. So it's not necessary we should follow what the equity markets in US is doing, because we have, as I told you, we have slightly started to get decouple from that. So we could see any fall to this day taking place could still be corrective, and it may not go below the general expectation is that it may not go below this low. It may not go below this low, which was the 15,183. 15,183. So we expect the fall now, all the falls to probably, this is so 16,250. I think 16,250, around 16,250 can be a bottom, and probably again we may start rising. 16,240, 250 could be an important area to watch as far as market is concerned here. So this is Nifty for you. Bank Nifty also in a monthly chart we should see this particular so this time the fall that took place was held a little closer to 38.2% retracement. So when it rose up, I think the 23.5, we said 39,550 we had been mentioning would be a very, very important resistance. That is what we had mentioned earlier. So right now there is a chance that it could probably go towards the 61 point. This it can come to 35,910 at some stage during its fall. It can come closer to 36,000 levels, and that is the place where you can look for investment. So whatever that we are talking from the chart point of view, you're talking from the investment point of view, not from, because trading you can't do exactly with the monthly chart, but you are talking from the investment point of view, where probably the 35,850, 860 levels can give a good support for the Bank Nifty. So with this we are ending today's session, And you may remember that in the currency market we said clearly buy dollar INR. Last week we have been identifying, saying that buy dollar INR. Okay, so that has done well. Euro INR we said sell between 80 to 81. So it is something around this 80, 30, 80, 40 levels. GBP also we said sell between 90 to 91. Of course, it's hovering on 91.50 to 92. It will come down. So all those investments are looking to make more profitable from the currency point of view. That could probably be more profitable. So now you can ask your questions. Thank you very much. So any questions, please? So thanks for your participation. So happy weekend. Thank you very much. Bye.